After precipitating the disaster that became known as the global financial crisis 5 years ago, there has been plenty of debate around what activities investment banks should be involved in. A recent article by Forbes columnist Steve Denning suggests that it's business as usual for investment banks, and the risks posed in the gigantic derivatives market are even larger than the ones created in the global financial crisis. Kokkie Kooyman, Global Fund Manager at Sanlam Investment Management, joins us in Cape Town now to share his views. Kokkie, thanks so much for your time. I know Warren is keen to kick off the discussion with some context.
That's right, Bronwyn. It's great to have a local Masters of the Market here. Kokkie Kooyman is the third one that we've profiled this year, and the first one from our local investment scene. So we're going to pick Kokkie's brains around banks, and specifically Kokkie's specialty is banks. The first slide we just wanted to bring up to introduce the show introduces some of the ideas around the problems facing investment banks. We've got just to bring up the pedigree that we're talking to with Kokkie and why we've made him a master of the market. He's recently just been awarded the UK Lipper Award, which is the best 3-year risk-adjusted returns in a particular sector, which is the equity sector for banks and other financials. Of course, he's also won, I think, for the third consecutive year now, the Investment Week Manager of the Year for his Global Financial Fund. So the first thing we're going to get to is a quote that Kokkie made probably about a year ago to me at Investors Monthly. I asked him whether he had ever owned a global investment bank. Obviously, they've been labeled as the bad boys of the global economy for their role in the global financial crisis. Kokkie told me he once bought Goldman Sachs and then almost realized the wrongdoing of his ways and promptly sold that about a month after buying it. So we're going to use the basis of the article by Steve Denning for our discussion around global investment banks. And the first question I had for Kokkie is, does he own a global investment bank at this point?
The only one we do actually own at the moment is JP Morgan, the one who got caught with a big trading loss. But there again, when the trading loss became apparent, we didn't own them. And we just had a look at the share price, about how much it had fallen, and did a rough calculation in terms of the maximum loss, and said that the share price had fallen much more than the loss. But the underlying, we are never happy investors in investment banks because, as you pointed out, the huge uncertainty about the earnings. And in fact, any trading earnings we normally put on no PE. So if I have a choice, I'll rather always own a retail bank or commercial bank than a bank that's heavily skewed towards trading activities.
Going to go straight into the furore around Cyprus and what is happening and unfolding there in the banking environment. And perhaps, Kokkie, we can get an update on the state of banks in Europe as a result of this latest crisis.
Yeah, it's actually been much more of a game changer than actually we thought ourselves it would be as well, because Cyprus has been seen as very small, insignificant, but what has been a game changer is the statements of the ECB and the leaders there, and one specifically has been that large banks we don't like. Number two is that large depositors effectively must do their own homework and won't be protected by the state or by effectively taxpayers' money. So what is the impact of that? As you saw yesterday, for instance, in a day where ABSA went up 2%, clearly unaffected by what's happening in Europe, but SocGen, Societe Generale, one of the biggest banks in Europe, went down 6%. So clearly the market is suddenly very worried, and I think to an extent correctly so, that large deposit holders in banks are suddenly going to start spreading their deposits, are going to really make sure that the banks they place their deposits with have enough capital, are liquid enough, and do not have a lot of risk taking on their balance sheet. So the effect of that on Europe is that suddenly banks are obviously very uncertain about their deposit base, which will make them more nervous about committing to large lending products. So I think what unfortunately this has brought about is that there's a lot of uncertainty again in the banking environment, which will impact on European growth.
Kokkie, obviously, Cyprus as a percentage of the GDP of the EU is so small. Many people are saying that this is possibly being waged as a proxy war between the EU, who recognize Cyprus's tax haven status and don't like that, and obviously the implication that there's a lot of Russian money that's there as well. So is there a political aspect to what's going on in Cyprus, aside from the fact that the country does need a bailout?
I mean, there are huge political impacts there. I mean, the fascinating thing is that Russia itself would really like to control Cyprus, in fact, of just its oil reserves, just having a port in the Mediterranean, etc., etc. And so it's been quite surprising that they didn't offer to come to the rescue of Cyprus as Cyprus had hoped it would. But if you just stand back, what had really happened is that a lot of Russian money flowed to Cyprus for the tax status, to the extent that Cyprus, the Cypriotic banks had too much in liquidity in deposits, and they promptly went and invested that in Greece. So when Greece fell over, suddenly these banks are effectively bankrupt because they had to take big write-downs on the investments, and they couldn't pay back the depositors. And that's really where the ECB and specifically Germany said, look, there is just no ways we're going to pay out Russian depositors who should have known what they were doing and were taking risk. And so to a certain extent there's a bit of politics, but I think were they German investors, maybe it would have been slightly different because it's Russian investors. There's a political angle there. But in the end, I think the ECB there did do what I think should have been done and will be done a lot more in future, that depositors who don't do their homework will be punished and will suffer loss.
Kokkie, I wanted to just cut to the chase here. Obviously, Steve Denning writes this article about global investment banks, and he was being cynical when he said that it's back to business as usual. We've talked a little bit about JP Morgan, but obviously had a fantastic reputation prior to this London whale crisis. Steve Denning in his article talks about the bank internally hiding risk from the likes of Jamie Dimon and the executive management team. If we take the large banks we can think about HSBC, is it a question of culture that we're facing here with these banks, that they just haven't cleaned shop yet? I mean, we've had them so reckless that they're bordering on the criminal. Is that the main reason why we should stay away from these large financial institutions?
So almost, if I can add to that, a leadership crisis in the banks, and that we don't actually know the direction from here.
Yeah. Look, one has to not generalize here, and obviously we're talking specific banks. We're talking JP Morgan, potentially also Morgan Stanley, Citigroup. In the UK, it used to be Barclays, and then you're talking maybe UBS, Credit Suisse. So very specific banks who have a large part of the banking activities in trading. JP Morgan, for instance, has a very large corporate lending book and a retail lending book, which is actually run very successful. But Jamie Dimon actually gave it away at the time of the loss, in that the trading they saw as a sweetener to try and increase their returns on equity. And he of all people should have known that trading in the end is a zero-sum game. You're going to win a few years, you're going to lose a few years. And what was noticeable last week in London, I attended the Morgan Stanley conference there and listened to Anthony Jenkins, the new CEO of Barclays, and also Lloyd's, Royal Bank of Scotland, Stephen Esther, etc. But the new bank CEOs that have come in are certainly trying to clean up and are trying to clearly differentiate themselves from their predecessors. So Jenkins, the word, ethical behavior, being client-focused, cleaning up, was sort of every second sentence had one of those phrases. So you can see that the new guys are trying to come in. Jamie Dimon, in that regard, he became arrogant, and in that regard, it's sad. I think he's been brilliant, but he got seduced by trying to increase his returns with trading, and he hasn't seen the error of his ways. And maybe at the end of this, he'll be forced to go. And then, you'll start a new culture at JP Morgan. But I think what you did allude to is correct. The old banks or the old managements, the culture, the DNA was wrong, and it was very much trading focused. And I think to a large extent, whether they knew the specifics, but they did allow a lot of this to happen.